Hey guys, welcome back to another episode of In the Charts. I think we might be a little pressed for time for this one, so we're going to run very quickly through these three charts, and I'm going to start off. Let's see. Okay, so before I start with this chart, I'll give a little bit of like a preamble just for some context. So Solo is this like group of people in San Francisco that are starting an initiative to support solo founders. I guess they're trying to go against conventional wisdom that you need multiple co-founders to start a successful startup in this day and age. And so they have a solo founder program where they like actually do like an accelerator, and they have a community of solo founders and all that stuff. But outside of that, they've also done a lot of work with Carta to get data on what it's like to be a solo founder and how it's changed over time. And I feel like it's interesting context for us just because in the last few weeks in this podcast, we've talked about the impacts of AI, solo entrepreneurs, things like that. And I came across this report and it showed some data that was kind of cool. So maybe first thing I'll start out with is that in 2019, a quarter of all new startups were solo founded. And then at the bottom of this year, 2025 now, it's over a third, and it's only accelerating. And I think probably because of AI. And then this chart, which I'm going to actually talk about, is another interesting chart that I think might impact the psychology of the next solo founder, which is that the time to liquidity or the time to exit between multiple co-founder companies and solo co-founder companies has flipped. So in 2019, the time to exit for a solo founder company was a year and a half longer than a multi-founder company. And then fast forward to 2025, and it's actually a year earlier. And so on the one hand, like I kind of look at this chart and I think like, as an investor, should I be investing in more solo founded companies? If it's faster time to liquidity, faster time to exit, like that sounds great. But then you also know that the time to IPO has also like increased over time. It's gone from like sub 10 years to now over 12 years to even longer for some of the most successful companies. And so I kind of end up asking myself this question, which is like, is this actually a story to faster liquidity for solo founders, or is a story of solo founders cutting it earlier and not actually getting the benefits of like working on something for 12 plus years?
Well, first, Chris and I have to decide whether this is actually a chart and it counts or not, because this does not look very much like a chart to me.
Ooh. Oh, come on. Chart, graph, visual. It's
The
all this.
second thing that I think is interesting is that something that I think would be fantastic would be that the first thing that came to mind is, okay, I want to bet on solo founders. But then the second thing that came to mind is maybe solo founders exit for lower amounts.
Exactly.
And so the exits actually may not be as good. So we definitely need this to be a little bit of
This
weighted
is like the
towards.
K-shaped economy, right?
That's right. So they're kind of like just getting out. And look, my actual personal experience is that being a solo founder must be, well, having a co-founder is extremely important because basically like you're always going through the peaks and troughs of desperation and like the crazy times. Then you're never quite in sync. So there's like a sinus function. You sort of like both of you could take the other side of the argument, or one is particularly negative, the other one is positive, and vice versa. And so I can see how having a co-founder kind of like just allows you for longevity, because there's another person pushing and pulling and there's there, and you're not never, sad at the same time. So that's emotionally and psychologically, I can understand why this will actually be the case. So this actually would be what I expect. Solo founders get tired, and then because obviously they're solo, and then they sell much quicker than everybody else.
It's just interesting because like my initial reaction was the same, which is like, bullish solo founders. And then you think about it a little bit more and you're like, wait, actually, maybe it's bearish for the VC. This might be great for the solo entrepreneur, right? But for the VC who needs like outlier returns, maybe this is actually not a good thing.
I wonder what actually is the catalyst, or if this is just like a coincidence. Like, I wonder if there actually is there's a clear reason for why this is happening. And I mean, AI is not obvious because, 6 years from 2023 is still, like in 2017. So it's a 2017 cohort company. It might actually be more, like maybe it's actually SaaS rather than AI. In that, the cost of starting a company has gradually come down over time, and obviously that trend is accelerating even faster with AI. But if you look at a 2019 cohort, or sorry, if you look at a 2019 exit year company that's been around for 6.5 years, right? That's like a 2012 cohort company. They had to build a lot of stuff, infinitely more stuff than a 2017 cohort company, where you could borrow more parts, or there are more standard ways of doing something. Not only that, I think there's also a knowledge issue where there are executives that have done this before and have sold PLG motion SaaS, and they exited that already, or they've grown it to some level of ARR and they can go to another startup and do it again. And so, you know, before, it's like you would have had to have maybe just more bodies, right? That are creative, experimental, first principles, founder type people. And maybe you don't need that as much going forward. And obviously that's, again, accelerated with AI. So I don't know what the real catalyst is, but that's kind of where my mind went.
Yeah, that makes sense. This is like another reading of it is basically like in a 20-year cycle for SaaS, the second 10 years are just going to be more experts. You don't need to know as much, and you know the playbook, so you can do it with a leaner team. But AI will only accelerate these things, right? Like with more accessibility to startups, we'll have more. Like I expect the numbers to go down. We'll check back in on this next year, and it'll be like 5 years for solo founders.
Yeah. It is interesting that the actual like absolute number has not moved significantly. Like it's still within some pretty consistent band, which is pretty interesting.
Yeah.
I would still not recommend anybody doing solo founder. It's a very lonely journey.
We do back solo founders though.
We do, but only the best.
Who's next?
Chris, you're up.
I think I'm next. Okay. Yeah, I've got a.
Is it an actual chart?
Oh, it is a chart. This is undoubtedly. Well, I cheated. It's 2 charts, but
beautiful.
So it's not.
But it's the same thing. It's just one's trailing 12 months and the other one is actually by month. So I found this and I thought this was. It's obvious, but I thought it was interesting to actually just see the data. So on the top chart here, what you see is iOS apps released every month. So that's the x-axis. And then it's the actual growth rate of the apps released by month. And this is a year-over-year growth rate chart. So it's like if this is at 0% in February 2025, that means that it hasn't grown at all in terms of the number of apps released since February of 2024. So, and then the bottom chart is just the trailing 12 months average instead of the actual monthly figure. And what you see here is just this explosion of the number of apps released by month in terms of a year-over-year growth rate since February of 2025. And, this is really when agentic coding really started to take off. I think it's really interesting to see this because, sadly, these 2 charts don't go back all the way, but I wonder what this would have looked like if you actually plotted this over when was the iPhone released? 15-year time frame. Because I think you would have seen this like massive spurt of growth in terms of the number of apps, and people would actually download them, right? Like the actual top charts on the App Store would actually change. And then that thing has ossified. And really, the top 10 kind of are the top 10. And, how many new apps are you really downloading on your mobile phone and like using it on a daily basis these days? It's a pretty rare occasion. So I think it's really interesting. This is a revival of the app economy in a way that we haven't seen in many years. Curious if this will actually stick around or if these end up being the like flashlight apps of our time. But I thought this is interesting to show.
So I saw this chart coming through, and I thought a little bit about this. So first and foremost, I think the obvious one is, this as technology increases, the efficiency with which a resource is used, the total consumption of the resource increases rather than decreases, right? Typical Jevons paradox is sort of what we're seeing. The second thought was obviously AI slop on the App Store. It's just like these things are not obviously going to be great apps, but you can submit whatever trash you want. The third thought was obviously, like anybody that believes that the apps won't increase in quality is also fooling themselves because it's AI slop today, but the quality of the apps will increase significantly. And then finally, I think it got to this other thought, which is what we're seeing is 2 things. is not just people wanting to create apps to sell and release on the App Store, but I think what we're seeing is the App Store is actually a choke point for delivery of an app, even for yourself. Many people that want to use apps, or like even within their friends, or even myself, they kind of want to publish. There's a few ways to kind of like do it and run it on your phone without actually being published to the App Store. But if you want an iOS native app, the best way to do delivery, or the easiest way to deliver, is sort of to publish this if you target audience is just you, or you and your buddies and your wife. And so you have to go through this process. So one thing that we may be seeing is vibe coding allows you to build small apps, and the pie of small apps for just for fun and for like small use cases is exploding, and you have to go through the App Store for delivery anyway. And that does not mean that all these people want to like make money and they're doing flashlights to sell this. It just means that there's a new increasing pie of like apps for myself that have to go through the App Store to be delivered. That was kind of like the final thought that I had of maybe that's the expansion, or the biggest portion of the expansion of the pie.
Yeah, that resonates. The personalized software thing, like the more like boutique software, like definitely feels like a trend that people are, that will only continue. But my question for you guys in looking at this chart is like, have you guys found yourself personally downloading more apps as a result of this? Like outside of the actual Frontier Labs, like I haven't used too many of the mobile AI products.
So
And I wonder if that's
what has happened to me is I'm using Expo.go for like apps that can actually be delivered on the phone. They basically allow you to kind of like have these as basically iOS native apps. And you can just do Replit type of development. And the other thing that I do is I use responsive applications that I built for Vibe Code, and then I basically add them to home screen. And so it's basically like a glorified Safari browser that opens on the iOS. So for a Raps tracker or a personal CRM or whatever, like I do have like a icon on my phone. So the number of icons is increasing for me. Actually, it is the number of apps that I'm using on a daily basis. But in my particular case, I'm not doing delivery through the iOS store. I'm doing delivery through either Expo.go or directly like as a home screen responsive app.
That's cool. You're like, it's like the homebrew era of mobile development for you.
That is exactly right.
I'm definitely not that much of a power user of this stuff to where I'm building my own.
I think you will be, because again, the only thing, so we've been talking about like you're doing a development of a cool application for us over here. And I think what you're going to find is with 30 minutes more of effort, you're going to be able to build an iOS, basically a web responsive version that you can then like add to home screen, and all of us will have a dashboard for exactly what's happening on the go. Then you will put the extra 30 minutes to do it because it's just 30 minutes. It's going to be really useful. So you will also see like the number of icons. Once you do it once, you'll see the number of icons exploding.
That's cool. Chris, are you downloading more of these things?
I'm not yet. I'm not yet. I do want, I was trying to think of what isn't it like an example or an analogy. I mean, Jevons paradox is like absolutely real for sure. That is a real thing. But at the end of the day, we also are fighting for attention of our time, right? So it's like at the end of the day, you can't expand the fact that you have 24 hours in a day. Like that is not something we've been able to,
not yet,
to figure out how to expand yet. And so at some point there's like a saturation point and you're taking share away from something else. And like over time, I think mobile has taken share away from everything else, frankly, right? Reading, TV, just socializing, offline, going to a bar, like mobile, and social entertainment on mobile devices has, generally speaking, taken share from everything else in your life over the past 15 years. And I kind of feel like, what's that?
When you put it that way, it's kind of dark.
I mean, it's also made people productive. It's made some people more connected. I think there's pros and cons to it for sure. But to me, the not downloading any more apps thing is almost like I've reached saturation point. And so I am wondering how this will actually shake out, because Jevons paradox is real, and I do think personalized apps sounds appealing to me. Like if I can, instead of having to go download some standardized app, just say like, hey, my life works in this way, like can you spin me up something that fits to my life? Like that seems better for sure, and I would use that more. But at the same time, like I've reached saturation point on my mobile devices and how much I use.
Like I'm going to just share one thing, which we've also discussed we brought a chart of the software rotation, right? Rotation out of software how the software companies and tickers have been like heavily sold, potentially oversold. But one thing that I have right now on my phone that is one of these apps, my wife is getting into real estate and she wants to be a real estate professional, and real estate professional requires you to track all of these hours. So you can go through the hours that you're actually spending substantive time doing these types of activities. So I kind of like looked around and I saw all these like reps tracker softwares, and there's like $30 a month or $50 a month or whatever. And every time I see one of these, my instinct is I can build this for less than $20. So that is what's actually changed on my, this is every time I see a piece of software, I can rebuild it in less than $20, and I will have a lot of fun doing it, and it will be much better than whatever outcome they have because it's going to be personalized to my use case. And I just can't unsee it. Now I see the world through this lens of like how many credits is it going to take me to like rebuild this app. And by the way, the outcome is better. In many cases, I think I can't build animations and like tons of integrations. And there's software for which I'm just not going to attempt. Obviously, it's like too big. Network effects that I don't have access to. But for like this first layer, that is kind of like my instinct now is the way that I think. And I think you guys are going to start feeling this way too. So what is it replacing? I would still spend, or my wife would still spend the time on this app kind of like doing the logging, but instead of an external app, now it's an internal app. So kind of like moving that to kind of like we're moving into the fold.
I can definitely see that.
That resonates.
All right,
as well.
Diego.
I'm up.
You are up.
So I brought you guys a single chart because I am a rule follower. And here's the chart that I have for you. It's a really fun one. Fun for a couple of reasons. But first, let me describe the chart. The title is Venture Contraction, and it shows year-over-year change of the number of active and total VC firms over time from 2015 to 2025. And essentially what's happening, and that's kind of like the highlight first, TLDR, is that after 20 years, we're actually facing the first meaningful industry-wide contraction since the dot-com collapse. There's actually a smaller active investor base than ever in the past 25 years. And that's really interesting because we've seen the booms and busts, we've seen all of these things, but the data is actually the first time that is actually showing it. And so the data generally says that there's over 100,000 venture firms that exist on paper in the US. This is data from PitchBook. And then fewer than half of them are actually actively investing. And so the rest of them are actually zombies. And they contribute to this illusion of growth, but not actually adding to the market activity. And then half the funds that are started actually are able to raise fund two. And only 17% of them actually become established. And that means basically like reaching fund four or above. And then less than 5% of them reach fund seven. And so the franchise potential of like reaching the threshold, it's really, really interesting data that is happening. And so I just wanted to bring this because it is a lagging indicator to a certain extent, but there have been so many things that have happened in venture, and it's actually the first time that these things are finally showing up in the data. So I wanted to bring it to you guys. We know that like fundraising is hard. We know that AI is distorting a lot of things, but this chart to me was pretty interesting because there was a leveling off, so we knew that this was coming, but it's finally here.
I have so many thoughts on this actually, and I haven't quite organized them. I mean, the first one is that I was thinking about, okay, so 2025. I wonder, like, I would love to see this on a cohorted basis in terms of which VC firms are becoming inactive. And what I can't figure out is, okay, is this like a 10-year-old VC firm and the partner is retiring now? Or is this like a VC firm that was started in 2021 and when money was a lot easier to get, and those funds are now reaching end of life because they've invested their 3 or 4 year period. And I would have to imagine it's a bit of both. We've had this, like, generally speaking, great macro boom. So set the like technology thing aside for a second. We've had generally this great macro boom in the economy, right, over the last 15 years with low interest rates, and there's just a lot of growth. And then you layer on technology as one of the biggest beneficiaries of that. And I think it's natural for the venture industry and the startup industry to grow massively. And then obviously you reach some local peak, because it's probably not I don't think it's the absolute peak. I think it's probably some local peak. And yeah, macro is just significantly harder in 24 and 25. Like, that is just a fact. interest rates are higher. There's more volatility. AI is kind of holding up, our growth and economy, on its back. And so without that, I think you would have seen much worse numbers. So I don't know I don't know if this is the like 21 cohort of venture firms rolling off, or if this is the old ones and the partners are like, look, this is now just a lot harder than what it used to be. And like, it's a good time to retire. Like I've done my part. Might be both.
Yeah, I kind of went to a similar place. Like my question was, does the 357 venture funds that didn't get funding matter in a world where you have Andreessen Horowitz taking 18% of all venture dollars in 2025? Like I would love to see where the venture dollars are going and the distribution of the 6,000 firms that are still active, because my hunch is that Andreessen's raising more dollars year over year, and they're but like the total venture dollars to the ecosystem is going down, so their share is increasing at a rate that we haven't seen before. So it's an interesting data point of like the bigger funds are getting bigger, but maybe the long tail firms like Chris mentioned that raised money in 2021 are just like not able to raise a fund 2 or a fund 3. That's kind of where I went. There's a consolidation happening. Clearly.
Yeah, and the phenomenon is getting definitely more. It's funny that it's power law within the venture firms themselves. The capital distribution is going to be 80-20 for sure, Pareto. I still enjoy funding everybody that I know that kind of like starting a fund for the first time. I love like first time managers, and I always like put a check in. I love LPing into first time managers. So I feel like I'm always trying to personally push the trend towards the opposite, from the mega funds to the first time funds.
Agreed.
Yeah,
Agreed.
there's that bifurcation thing, because there are more startup funds, I think, that you hear about. A lot of people spinning out of great funds. A lot of people, using AI as like a catalyst to start something new and that looks different. And then simultaneously, as Breck mentioned, you got venture dollars starting to consolidate at the top end of the range. So you're getting this kind of like bifurcated industry where the upstarts are also like, they're doing well too, right? I can name plenty of funds that have started in the last couple of years that are doing great. So
yeah, definitely the ones that kind of got the timing right,
Yeah.
that started like right before or right at the moment that ChatGPT came out, like those right now in terms of markups. But you guys know TVPI, not DP, not DPI, and so what we want is the opposite, right? And I also think it's interesting, the final thing here, and we don't have a chart for this, but on this one, it's like we really need liquidity, and there's a lot of these, I guess, asset acquisitions that have real liquidity, and so that is a big proof point. But we haven't seen an IPO of this magnitude, and so expecting these things to IPO at $1 trillion when there's been basically like all the IPOs of the past 6 months are trading down quite significantly, and so it's going to be really interesting to understand whether like the private markets are totally off in terms of valuation versus public markets. That's going to be the real like defining moment for whether all of these actual funds that were created there are gonna make it or not. But anyway, guys, another great episode of In the Charts. I'll see you guys next week.
See y'all.
See you guys.